Welcome to Talk Tickers.
It's great to be here.
Today, we're doing a deep dive into something that feels a little abstract at first, but it really determines the value of every single dollar in your wallet.
And every asset in your portfolio, it's a foundational pillar of modern finance.
We are talking about the independence of the Federal Reserve, and specifically the erosion of that independence.
Which is undergoing, I would say, its most significant stress test in decades.
Exactly. So this isn't just about interest rates today. We're looking at the whole governance structure, the machine that actually sets them.
Great.
And with some of the executive orders we've seen in 2025 and 2026, and just, the political rhetoric from both sides, this whole question of who controls the money supply it's moved from textbooks to the front page.
It's the classic Ulysses contract.
Explain that.
Well, in the myth, Ulysses has himself tied to the mast of his ship. He does it so he can hear the beautiful but deadly song of the sirens without steering the ship onto the rocks. Modern central banking is built on that exact same idea. You lash the central bank to the mast, you insulate it from that siren song of short-term political pressure.
So they can focus on long-term stability instead of, say, an upcoming election.
Precisely. But right now, it feels a bit like someone is trying to cut the ropes.
So let's unpack that. For anyone listening, why does this matter for their portfolio, today?
Because the market prices everything, stocks, bonds, everything, based on one core assumption.
Which is?
That the Fed will act like a technocrat. That it will move rates to manage inflation and employment based on the data.
And not based on politics.
Right. If the market starts to believe the Fed is acting like a politician, maybe moving rates to help win an election or to make it easier to fund the deficit, then the entire risk calculation changes for everything.
Okay, so before we get into the doomsday scenarios, what's the state of play right now? We have this image of the Fed as the chaperone who takes away the punch bowl just when the party gets going.
And that's been the historical view, sure. But recently, it feels more like the chaperone is being told to spike the punch.
And that's the core conflict, right? This tension.
It's a tension between what people call democratic accountability, where elected officials want control over economic levers.
Because they're the ones who have to face the voters.
Exactly. And on the other side, you have technocratic insulation, the idea that you need experts to manage this for long-term stability. And that old consensus that independence is always good for inflation, it's starting to crack.
And this isn't just talk, is it? There are actual proposals being floated.
Oh, absolutely. We're seeing everything from proposals to shorten the terms for the Board of Governors.
Which would make them more sensitive to presidential cycles.
To fully nationalizing the regional reserve banks, which would be a massive structural change.
So what's the bottom line here? What's the real risk?
It's one word: credibility. Economic models are pretty clear on this. If the market's confidence in the Fed's independence starts to erode, you get a condition called inflation persistence.
That sounds clinical, almost like a medical condition.
In a way, it's an economic disease. See, when credibility is high, a spike in inflation is like a temporary fever. The body fights it off, and it snaps back to normal pretty quickly.
But when credibility is lost,
that fever lingers. Inflation starts to bleed from today into tomorrow. And that's how a temporary shock can turn into long-term grinding stagflation.
So to understand how we got to this point, this precipice, we really need to look back, because the Fed wasn't always this powerful, independent entity, was it?
No, not at all. You can think of it as having three foundings.
Okay.
The first was in 1913 when the system was created. And back then, it wasn't a monolith at all. It was a very decentralized, complex web of committees.
Then came the Great Depression, which changed everything.
Right. That led to the second founding in 1935, a major restructuring that centralized a lot more power in Washington, D.C. But the real pivotal moment, the divorce you could call it, was in 1951.
The Treasury-Fed Accord.
The Accord. This is the key. Before 1951, the Fed was explicitly the Treasury's helper.
How so?
During World War II, the Fed just pegged interest rates at a very low level. Its job was to help the Treasury finance the war with cheap debt. Full stop.
But that couldn't last forever.
By 1951, inflation was really starting to rise from the Korean War, and the Fed wanted to hit the brakes. The Treasury, of course, wanted to keep its borrowing costs low. The Accord was the moment the Fed formally separated debt management from monetary policy. It was its liberation.
But that liberation didn't guarantee its safety, and we have a very clear cautionary tale about what happens when that independence fails.
Yes, we do. Richard Nixon.
The 1970s.
It's the textbook example of a catastrophic failure of independence. In the run-up to the 1972 election, President Nixon put immense pressure on the Fed chair at the time, Arthur Burns,
To keep the economy roaring.
to keep money easy. He wanted low unemployment and a booming economy when voters went to the polls.
And Burns, he caved.
He capitulated. He put Nixon's re-election ahead of the long-term health of the economy, and that political subservience was a huge contributor to the great inflation of the 1970s.
And it took years to fix that.
It took nearly a decade and the incredibly painful tightening under Paul Volcker in the early 80s to finally break that inflation and re-anchor people's expectations. A truly brutal period for the economy.
So we have this history, this struggle, but I think a lot of people just assume the Fed's independence is, written in stone, like it's in the Constitution somewhere.
That's a common misconception.
Yeah.
But it's not even close to being true.
It's not constitutional.
Not at all. It's statutory. The Fed was created by an act of Congress, the Federal Reserve Act. And anything Congress creates, Congress can change.
Or get rid of entirely.
Or get rid of. The argument is that the Fed is independent within the government, not from the government. Its mandate for maximum employment and stable prices. That comes directly from Congress, from the Humphrey-Hawkins Act. It is, by its very definition, a creature of Congress.
Okay, let's get into the mechanics of this creature then, because the way it's designed is actually pretty clever in how it tries to shield itself from that political pressure.
It is. It's really a system of checks and balances. You start with the Board of Governors in D.C.
7 members appointed by the president, confirmed by the Senate. That sounds political.
It is. But here's the shield. They serve 14-year terms.
14 years, wow. That's 3.5 presidential terms.
Exactly. The whole idea is that they will outlast any single presidency. You can't just come in and stack the board overnight.
Okay, that makes sense. And then you have the regional banks.
The 12 quasi-private banks. And this is where a lot of the controversy and, frankly, the confusion comes in.
Because they're not technically government agencies.
No, their boards are a mix. You have Class A directors who are private bankers from the region, Class B who represent business and the public, and Class C who are appointed from the board in D.C. It's a structure designed to bring in voices from outside of Washington.
But the real superpower, the biggest shield of all, that's the budget, right?
That's the one, the power of the purse. The Fed does not rely on congressional appropriations for its funding. It can't be starved of cash by politicians who don't like its decisions.
Where does its money come from?
It funds itself, primarily through the interest it earns on the massive portfolio of securities it holds and from fees it charges banks. That financial independence is a massive, massive shield against political leverage.
But you could argue the Fed has made itself more vulnerable lately by expanding its mission, this idea of mission creep.
This is a critical point, a really critical point. After the 2008 crisis, and especially after COVID, the Fed started using these emergency powers Section 13.3 facilities and doing these huge asset purchases.
Quantitative easing, or QE.
Right. But they went from just buying government treasury bonds to buying hundreds of billions of dollars in mortgage-backed securities, even municipal debt.
So they went from just controlling the amount of money in the system to actively directing where some of that money goes.
That's it, exactly. They moved from pure monetary policy to something that looks a lot like credit allocation. And when you're buying mortgage bonds, you're effectively subsidizing the housing market. You're picking winners and losers.
And once you start picking winners and losers, the politicians want to say.
Of course they do. You can't play in the political sandbox and then act surprised when you get sand thrown at you. When a central bank acts like a fiscal agent, it's only natural that politicians will demand fiscal oversight.
It's interesting because the data on this whole topic is a bit surprising. You mentioned earlier that we all just assume independence kills inflation.
We do. And the theory is strong. But some of the more advanced empirical models, they show a pretty weak link. The idea that central bank independence by itself necessarily lowers inflation is not as well supported as you'd think.
So other things matter more.
It seems so. The underlying structure of the economy, that inflation persistence parameter we talked about, those things often matter more than what's written down on paper in the bank's charter. Independence is a powerful tool, but it's not a magic wand.
Which brings us to right now, to 2025 and 2026. What are the specific threats that are on the table today?
Well, the big structural one, the elephant in the room, is fiscal dominance.
Meaning the national debt is just too big?
It's so big that at a certain point, the math just takes over. The Fed might be forced to keep interest rates low simply to ensure the government can afford its debt payments and remain solvent.
So the debt itself puts a ceiling on how high the Fed can raise rates to fight inflation.
Correct. If raising rates to 6% would effectively bankrupt the Treasury, then the Feds loses the ability to raise rates to 6%. Fiscal policy starts to dominate monetary policy. That's fiscal dominance.
Then you have the more direct political pressure.
Absolutely. The rhetoric about removing the chair or creating some kind of shadow board to second guess the Fed's decisions, even, a series of angry tweets from the executive branch has been shown to impact market expectations. It just chips away at confidence.
And finally, what you call the lackey risk.
Right. If appointments to the board are made based on political loyalty rather than economic competence, well, if the market believes the people running the machine are just rubber stamping what the politicians want, the credibility of the U.S. dollar itself is at risk.
Okay, let's bring this all home for the listener. We've gone through the history, the mechanics, the threats. If I'm sitting here with a standard diversified portfolio, why does this matter to me today?
Okay, so we need to think in terms of scenarios for, say, 2026. We see three main paths this could take.
Let's start with scenario one, the bad one.
The bad one. This is the credibility crisis, which leads to stagflation. This is what happens if the market fully believes the Fed has lost its independence.
Inflation expectations de-anchor.
They de-anchor. And critically, the correlation between stocks and bonds, which is usually negative, turns positive.
Meaning they both go down at the same time. The part of your portfolio that's supposed to be safe isn't safe anymore.
Exactly. Bonds fail to hedge your stocks. In this modeled scenario, a standard 60-40 portfolio could lose something like 11%. There's just nowhere to hide.
Okay. Scenario two, the hard landing, recession.
This is the opposite. This is where the Fed, to prove it's still independent, aggressively hikes rates into a slowing economy. They over-tighten to regain that lost credibility.
That sounds awful for the economy, but what about the portfolio?
It's actually less damaging, paradoxically. In a standard recession, yields fall as the economy weakens, so your bonds go up in value. The model here suggests a portfolio drawdown of maybe 5% because the bonds do their job and offset some of the losses from stocks.
And the dream scenario, scenario three, the soft landing.
The soft landing, or stable growth. This is where credibility holds, the Fed navigates perfectly, maybe productivity picks up. The models here show portfolio gains of around 4%.
So the key signal for an investor to watch through all this is that inflation persistence idea.
Without a doubt, watch the data. When credibility is high, a bad inflation report is a one-off. It snaps back. But if you start seeing inflation getting sticky, bleeding from one month into the next, despite what the Fed is doing, that's the canary in the coal mine. That's the sign that credibility is slipping.
Which brings us to the one question. For this deep dive, what is the single most important question listeners should be asking themselves?
The question is this. Is the market pricing in the Federal Reserve's stated policy path? Or is it pricing in the political constraints that will stop them from actually executing that path?
And why is that the key question?
Because if you believe the market is doubting the Fed's political will to inflict pain when it's necessary, then the inflation risk premium on all long-term assets is, frankly, way too low right now. It's significantly underpriced.
That's a sobering thought, that we've gone from the 1951 Accord that set the Fed free to a 2026 landscape where politics and debt might be putting the shackles right back on.
And it's crucial to remember, the Fed isn't a monolith. It's not an it, it's a they. It's a complex human institution that's constantly balancing its technocratic judgment with its own political survival.
So independence isn't a light switch, it's not on or off.
It's a spectrum. And all the evidence suggests that right now we are sliding slowly toward the dependent end.
Something to think about the next time you see a headline about interest rates. Thanks for listening to Talk Tickers.